Okay, everybody, welcome. Um, my name is Evan Press. I'm filling in for Fred Wallace, and Jeff Heller, the associate program chair, is helping me. Today we're going to have two, I think, very good presentations. We're going to have Alan Roth speaking first, and then we're going to have David Leibowitz speaking second. So let me do a couple of announcements, and then I'm going to turn it over to Jeff, who will introduce Alan. Okay, so here's our schedule for today. Everybody can see that depending on your screen size. So Alan's going to be speaking on viewing financial decisions differently. And then about 10:25, we'll take a break. At 10:45, we'll come back and Jeff will introduce David Leibowitz for investing in a post-COVID world. You can see here we have some upcoming events. July 17th, we're going to be featuring Mickey Jagadar. He's co-portfolio manager for Global Concentrated Strategy at Ariel Investments, speaking on From Placebo to Cure, a Contrarian Call. And then along with him, we'll have Ben Johnson from Morningstar, the ins and outs of investing with ETFs. In September, we have Jason Trennert from Strategis Securities, and we'll have Bruce Johnstone from Fidelity. October, we've got one lined up. We'll be back at the Skirball in January because we won't be meeting in December. So we didn't think it made much sense to meet at the Skirball in November, go dark in December and come back in January. So we're just going to continue with the Zoom meetings. July, August, we're dark. September, October, November, and then, as I said, January at the Skirball. We want to thank all of our generous donors. We really appreciate it. It's kept us going. We do have some ongoing expenses, even doing Zoom. We have some subscriptions we have to pay for. So I'd like to thank everybody for your generous contributions that help us cover chapter expenses during the pandemic. And we're going to build an audio video fund. We're hoping to arrange to have the Skirball meetings broadcast and then posted on our website. So the plug is, if you're interested in making a donation, please visit us on the chapter website, www.AAIILA.org. That's ORG, not COM. And you can click the contributions page and check with your CPA about this being a charitable donation. What else do I want to say? If you have any technical questions, anything like that, put them in the chat. Jeff and I will try and answer them. During the presentation, you can put your questions in the chat, or I think is there a Q&A, I believe, in this one also, and Jeff and I will gently prod Alan and David about these questions. Finally, I'll put in a plug for the retirement group that I run. Our next meeting is going to be July 10th, I believe it is and we're going to have somebody speak about the things that Medicare doesn't cover. A lot of people think that Medicare covers everything, and then they're surprised when they find out that it isn't covered. So that should help you.
Yeah,
So
that would be
let's
good.
see, I'm gonna, do I stop sharing now and turn it over to Jeff?
Yeah.
Yeah, there's Alan all dressed up. Okay, Jeff, it's all yours.
Okay, all mine. All right. Well, good morning, everybody, and thanks for tuning in. And we've got Alan Roth with us today. We're very fortunate. And Alan Roth is the founder of Wealth Logic, LLC. It's one of the few hourly-based financial planning and investment advisory firms out there. And he's also the author of a very interesting book. I encourage you to get it. It's on Amazon. It's How a Second Grader Beats Wall Street. What a title. So that's a good title. And he writes for the AARP, ETF.com, Financial Planning Magazine, and many others. And before launching Wealth Logic, Alan's career encompassed management consulting with McKinsey and Company, and also corporate finance, which included serving as a financial officer at two multi-billion-dollar healthcare companies. He's also taught finance and behavioral finance at the University of Denver, Colorado College, and the University of Colorado. And despite his many credentials, he's a CFP, a CPA, and an MBA. He remains confident that he can still keep investing simple. So thank you again, Alan, for agreeing to do the webinar, and the floor is all yours.
Thanks very much. Let's see if I can do the share screen now. Okay. Pleasure to be here. Can you guys, can you see the screen?
Yeah.
Okay, beautiful. Well, first of all, thank you for having me. I've been an indexer since the 80s. So my investing strategy is just dull and boring, and it isn't what I think of when I think of AAII, which is picking parts of the market, picking stocks, etc. However, I do have a little gambling side of me. I wrote a piece how Kramer made me 22% in 22 days when Mad Money's Kramer said 2 stocks to sell immediately, and I bought them both. But much of what I'm going to be talking about is going to be how my industry sometimes likes to frame things that may not be in your best interest. I know that's hard to believe that my industry would frame things in a certain way for their profit, but it's true. So I'm going to give a few examples. Asset allocation. I gave this to a group of doctors. If we take an asset allocation where the person has 500,000 in stocks, 500,000 in bonds, and they have a $400,000 house. Yes, they do not live in the Southern California area. And a mortgage of $200,000, what's their asset allocation? Most people would say it's a 50-50 between stocks and bonds because they have $500,000 in stocks, $500,000 in bonds, and a $200,000 home equity, the $400,000 home less the $200,000 mortgage, and a net worth of $1.2 million. And I say that's baloney. What they have are $500,000 worth of stocks and $300,000 worth of bonds and a $400,000 home, the same $1.2 million net worth. Now, why? Because when you buy a bond, you're lending money to a government, corporation, et cetera, and they're paying you principal and interest. A mortgage is just the opposite. And whether the house goes up or down in value has nothing to do with how you finance it. So, the debt is the inverse of a bond. And it turns out that borrowing money at 2.5%, let's say the mortgage, and lending it out at, let's say, 1.3%, which is now what a Barclays Ag total bond fund is paying, is not a great strategy. And it's especially true because the bond or bond fund is taxable, and typically the mortgage is not going to provide a tax deduction or very little tax deduction. So, my industry wants you to compare the 2.5% mortgage to the total return of the portfolio. And that's called leverage. And leverage works when the market goes up, and boy, does it backfire when it goes down. And I write about this stuff. And whenever I write about this, especially from financial advisors that make money, think about it, the advisor that's charging you a percentage of assets, the bank, they don't want you to view it that way. So I get a lot of hate mail from that. And, In one case, only a baboon would pay off the 2.5% mortgage. And my offer is, okay, you lend me money at 1.5%, I'll lend it back to you at 2.5%. Then you can invest it in the market and earn 8% and pocket the difference. No one's ever taken me up on that. So the next is, and by the way, there's only one reason why you want to borrow money at a higher rate than you lend it out at, and that's liquidity. If you need it to sleep at night, you're going to lose your job, emergencies, etc. That's the one reason to do it that way. Now, a cap-weighted index fund, and a cap-weighted index fund is something like the S&P 500 index fund, or even a better index fund, a total stock market index fund. And cap-weighted weights the largest, most valuable companies, the highest weighting. So it's going to have more Apple, Amazon, Alphabet, etc. So the common framing of this, and I especially heard this 5-10 years ago, it's guaranteed to underperform the market, which by the way is true. And you're just buying more of those overvalued large cap growth companies. Oh gosh, it's so obvious that Tesla is overvalued. How can it be worth more than the next 10 automotive companies put together? And then since 1928, small cap, those are the small companies, and value, those are the companies that are beaten up, that aren't growing fast. It's trounced a cap-weighted index fund. So that's the common framing. The economic framing is that a cap-weighted index fund, as boring as it is, must beat the average money invested in the stock market. Picking parts of the market or weighting it differently is active investing. And when you go back to data since 1928, well, first of all, I don't know anyone who's been investing since 1928. And two, even if you could, buying the small companies and the value companies would have been so outrageously expensive. And look at a boring cap-weighted index fund. Last year, we had a pandemic, surging unemployment, plunging GDP, racial unrest, political discourse like I've never seen before, and the market gained 21.03% as measured by a Vanguard total stock market index fund. All right, Jeff and Evan, I'm going to pick on you. You can answer one of two questions. What's the meaning of life? Or the easier one, what patterns do you see in this? Some are X'd out, some scores are X'd out, some are blank.
All the ones that have X's, they all have 3 X's.
That's true.
Mm-hmm.
And then the bottom, the lower right-hand sector, all of the boxes have X's in it.
Correct.
Okay. Whereas the upper left-hand, you only have 1 box with X's.
Correct.
So we want to be invested in the lower right, or do we want to avoid the lower right? I don't know which way to go.
Yeah, good questions. Okay. This I did on an Excel spreadsheet with a random number generator. So each cell had a 50% chance of, so yeah, we're really, really good as humans at finding patterns. And we often find patterns out of randomness. And there are now more than 600 different investment factors, smart beta, that worked brilliantly in the past and don't work going forward. So if we look at smart beta is kind of the term for finding some of these factors to outsmart the market. And the 2 most famous ones are the Fama French, small cap and value. And about 5, 6, 7 years ago, I couldn't be at a conference and go more than 3 minutes without hearing the term smart beta, small cap value, factor tilting, etc. And I wrote then why I'm embracing dumb beta, which is the old market cap sort of thing. And if you look at this, small cap value, this supposedly free lunch over a 5-year period, $10,000 investment gained about $4,000. Those so-called large cap growth overvalued companies, they gained 15,500, almost 4 times the return. So by the way, I'm sorry to brag on a recorded video, but I am incredibly good at predicting the past. It's the future that's a lot harder and that I know that I'm bad at. Things change. We'll go back to 1980. Look at the top 10 companies. And by the way, I went to work for number 3 after I got my MBA, Exxon, who later bought Mobil, number 7, and today is in the top 25. And look over at the right, the largest companies as of the end of last year, the most valuable companies. There's no overlap. Things change. Many of these companies didn't even exist in 1980. And if I knew the most valuable companies in the next 10 years, I would be richer than Jeff Bezos. I cannot prove it, but I am willing to say on a recorded line that I am not richer than Jeff Bezos. So again, the drivers of the stock returns can be, incredibly concentrated, and they typically are. In fact, if you look over I think it was a 31-year period ending in 2018, the average stock over that 31 years, the median earned 7%, while the market as a whole earned 2,100%. So, which is why I like owning everything. We're on a Zoom call right now. In the beginning of last year, I didn't know what Zoom was, but I owned it in my total stock index fund. But if we look at smart beta and even a Russell 3000, which essentially owns as close as possible to every company in the United States, if they weighted it differently, they got a 9.3% return. The total stock market index fund, that boring cap weighted, over 21% return. Why? Because a handful of companies over on the right were the ones that drove the return. And yes, I wish I knew next year's top 10. Now we have an addiction to prediction. And I love looking at these, different forecasts of what we think asset class returns are going to be. And Christine Benz from Morningstar is one of my favorite people. Ben Johnson, who's your speaker coming up, he's absolutely wonderful as well. But we've got to make predictions of what market returns will be, even Vanguard's predictions. And they do it well. They make a 10-year long run return expectation. But they're saying, if you can see the lower yellow highlighted bar, that's US stocks versus international stocks. They're saying that international stocks are going to perform a whole lot better. And that's possible, but with less risk. Look at the left tail. It's much higher, a higher return for international than US. So I wish markets were that inefficient, were ways to earn more with less risk. I don't agree with this, quite frankly. I do believe in a diversified portfolio owning international stocks. And then there are people like Jeremy Grantham. I wrote a piece, Profits of Profit. And look at the track record of how they've done. These are his current forecasts, pretty darn dismal for stocks, especially US stocks. But if you go back 7 years and look at his forecasted return, it was the same thing, whereas US stocks did a whole lot better. So we're really good, by the way, at looking at things like Harry Dent and his compelling forecasts. We're really lousy at taking the extra 3 or 4 minutes to do a little research on how accurate those predictions have been. Okay, next thing, interest rates. And I admit, I look at interest rates today and I feel really, really bad. But by the way, in investing, things that feel good are usually bad for you, and things that feel bad are usually good for you. I mean, let's face it, when I bought more stocks in March of last year, I wanted to puke as I was hitting buy. It would have felt a whole lot better to have hit sell when stocks had fallen 35% in 33 days. Now, interest rates. So interest rates are near an all-time low. Yeah, they've ticked up a little bit so far this year. And it was once so easy to get income from bonds, and interest rates have to go up. So we need to avoid bonds, especially except possibly the ultra short or floating rate bonds. So the better alternatives are the ultra short bond fund. Vanguard has one. High yield bond funds, which are often floating rates. By the way, those first two typically have another term known as junk, which is a really accurate term. Dividend stocks, REITs. I don't know if you guys hear these commercials in California, but I keep hearing NRIA, a safe 10% real estate return. If it was that safe, believe me, the pension problems that exist today would be solved with these very high assumed returns of 7.5%. Master limited partnerships, they're just pipelines, safe alternatives to a bond. Most annuities, individual bonds rather than bond funds. These are things that my industry likes to frame, but typically are very hazardous to your wealth. Now, I argue, being the most...
Alan?
Yes.
Let me ask you real quickly to say an extra word about REITs, because in my experience, they're very popular because, again, they pay nice commissions, a lot of the non-traded ones.
Oh, non-traded REITs are uglier than heck. When I'm talking about REITs, maybe something like a Vanguard REIT index fund. But yeah, the last thing you want to do is go after a private REIT that pays a 10% commission. They tell you there's no market risk. Now, believe me, just because you can't look up the price, every minute on the internet or at the end of the day in the newspaper or whatever, there's risk out there. So the better it is for my industry, the worse it typically is for you. So a private REIT, I wrote a piece for the AARP magazine, My Biggest Investment Mistakes, and I bought some private REITs on the secondary market at pennies on the dollar. And the lesson there was a dog at a discount is still a dog. So a private REIT, I would avoid like the plague, like that NRIA sort of thing. And in any private deal, a private deal that comes to you is typically bad. A private deal through a network or somebody you know or something like that is possible. But I've got clients with hundreds of millions of dollars that know they don't have enough capital to get access to the better deals. So when you pay somebody 10% to distribute the thing, it's typically quite bad for you. Other than that, I have no strong feelings. So let's say interest rates in 1981, I bring it up to clients. Do you remember when you could earn 12% on a CD and I get smiles? And I said, well, I smile too, but think about it. If you could earn 12% on a CD or a high quality bond, you invest 100,000, you get 12,000. A third of it went to taxes. You're left with 8,000 or 8%. And inflation was at 14% then. You lost 6% of your spending power. Rates were far worse then. And I argue that the purpose of fixed income has never really been income. It's been to be the stable portion of your portfolio and money to live on for the rest of your life. You actually can't take it with you. At least I've never found a way. And the top economists have called the direction of interest rates correct, meaning up or down 30% of the time, wrong 70% of the time. And that was really disappointing for me because I thought I was uniquely qualified to forecast interest rates wrong, but turns out that I'm up there with the top 50 economists. So there are better ways to earn more. A lot of 401k plans have stable values that were often they've got the worst 401ks because they were from the insurance companies, but the insurance companies had contracts where they were, had to give a certain return. If you work for a not-for-profit like a university, healthcare system, a lot of the, and you have to read each contract individually, a lot of the TIAA annuities have a 3% legacy out there that I wish I had access to. The thrift savings plan, the G fund yields 1 5/8% with no risk whatsoever. Direct CDs, insured savings accounts. I'm still earning 1% on my cash at a credit union backed by the NCUA, whereas my Vanguard cash or Fidelity or Schwab are paying 0.01%, and of course, paying down the mortgage.
Alan, before we move on, I know you're not going to have real strong feelings on this, but would you explain quickly what an MLP is and the risks involved? Somebody had a question about MLP stocks.
Okay.
Master limited partnerships.
Yes, thank you. Master limited partnerships. So they're publicly held companies, typically a pipeline company, like one that was in the news, Colonial, with the ransomware. And people kind of view these as just safe alternatives to bonds. They collect money to pass oil and gas through their pipes, kind of like a toll taker. But these pipeline companies have a ton of debt. And when things go wrong, debt is a magnifier of risk. So these are things that, they're a publicly held company. It's a risky investment, but to think of just safe returns, there have to be reasons for these safe returns, such as the G fund. It's backed by the US government and it's only open to US government employees. So that's a master limited partnership.
Thanks.
Insurance and inertia. In my book, actually, I think I probably have this wrong. I say that Albert Einstein called the power of compounding the most powerful force in the universe, and chances are he never said that. So I nominate inertia as the most powerful force in the universe. So when it comes to insurance, the industry likes to frame things that you want to protect yourself and your family no matter what. You want to buy as much insurance as you want. My personal favorite is, Jeff, do you love your family? If you love your family, you're going to buy permanent insurance. You're not going to buy temporary insurance because 99% of the time, term policies never pay a dime out. And you insure your house, why not insure your portfolio? Well, the economic framing is, guess what? Insurance companies are for profit. Even the mutuals need to make a profit. So you're making a bet. You want to insure for only what you can't afford to lose. And think about it, when we were young, if somebody steals some stuff from our apartment, it could be devastating. When we're older, probably not. So as wealth grows, the need for most insurance, not all insurance, but most dissipates. Permanent insurance is an indirect investment. Look at whether we're talking whole life, universal life, variable life, etc. Look at the balance sheet of the insurance company, and you're going to see that it's mostly in bonds, probably 85–90% in bonds, and you're going to get the return you could have gotten had you bought that portfolio directly, minus the commissions, costs, and profits of the insurance company. And then the economics. If you think of term insurance versus disability, term insurance, if you buy a 30-year term, you get the best deal in the later years of the policy because your chances of passing away are higher as we get older, darn it. And then the disability is just the opposite. It typically pays out to age 65. So I'll have some clients come to me, they're 63, 64 years old, and they're still paying the same rate for disability insurance when the most they could collect is after a 6-month waiting period is 6 or 12 months. And while it's true you insure your house, You don't insure your house. You insure your house for fire, flood, earthquakes, etc. You don't insure your house for a decline in value. Okay. Kind of my two pet peeves. I've covered they're the two M's. I've covered the mortgage. Now I'm going to cover the muni bonds. Okay. Why this is legal, I do not know. But the common framing is munis. These are tax-exempt municipal bond funds. And if you live in California and it's a California muni, then it's typically double tax-free. Okay. So munis provide safe, tax-free income from retirement. During the Great Depression, the loss on muni bonds was only about 0.5%. Munis are an inefficient market, and me as your muni bond buyer, I can buy you bonds yielding 2 to 3 times the return of, let's say, the Vanguard municipal bond fund. And a recent portfolio I built, returned over 5% federal tax-free. In fact, it was in California, so it was double tax-free. This is the pitch by my industry. Honest Al, I would never lie unless my lips are moving. Oh wait, this is being recorded. I did not mean any of this seriously, nor is any of this specific investment advice. But the economic framing is munis have, depending upon the assumptions, $2 to $6 trillion worth of unfunded pension and healthcare liabilities. So my philosophy is that munis could have a new correlation to stocks. So many of these pensions are assuming a 7.5%, 8% total return. And we know the fixed income, the bond portion of it, is going to return peanuts. So that if stocks don't do really well in the next decade, as all the baby boomers have retired, there could be some stress. I'm not saying avoid munis, but I certainly tell clients not to put more than 20% of their fixed income in munis. And of course, the baby boomers during the Great Depression hadn't retired. So now there's some additional stress. And then framing return of principal as income should be illegal. Let me show you how the trick works. So the illusion, honest Al, your muni bond buyer, I buy a bond with a $5 coupon for $112. So that's a yield of 4.46%, the $5 divided by the 112. Now the bond, if you read the fine print, it's going to mature or be called in 3 years at $100. So that means it's going to go down by $12 in that 3-year period. So that 12 divided by 3, roughly $4 of that $5 yield is just return of principal. So your actual yield is 0.89%. Now, am I exaggerating? Not in the least. A recent typical client I reviewed came to me thinking that he was earning 5%. Okay. But if you look at what has to be disclosed, the yield to worst, which is really a best case scenario, and it's a best case scenario because munis are typically callable. So that if we got into a high interest rate environment, high inflation, the munis aren't going to call those bonds, and you're going to be stuck with a below market return. So it was yielding 0.4%. The manager was charging 0.35%. So the net yield before the bid-ask spreads was 0.05%. And the bid-ask spread is, and that happens with the stock, if I sell Exxon and you buy Exxon, there's going to be a little market maker taking a tiny little piece of the return. But spreads on munis can easily be over 1%. It's like when you buy or sell a house, the realtor may take 6%. Munis, typically I see around 1%. The largest spread that I ever saw, it was a client who bought a bond, and he bought it at 10.25% over what the seller had recently sold it at. So the market makers pocketed the difference. That client, by the way, happened to be an attorney, a fairly senior attorney working for the Securities and Exchange Commission. He had no idea this was going on. And by the way, I've had a 2-hour meeting with the executive director and her senior staff at the Municipal Securities Rulemaking Board. Incredibly nice people, but guess what? When you're a self-regulatory organization, you come up with rules that are good for you. Okay. What to do with the expensive dog fund? I'm just going to go through this really quickly in the interest of time, but you know, I've made a lot of mistakes in my investing life, you know, owning some funds. One Dreyfus S&P 500 index fund, Dreyfus went out of business and they deserved to, that had very high, that jacked up their fees later on. So anyways, the analysis is, do you continue paying the higher fees or do you pay the capital gains tax? There is a value in the time value of money. You also have to look at the tax efficiency of a fund. Funds can trade. Those trades pass through capital gains whether you sell or not. And it's usually not binary. When you sell some, use the specific lots. And for gosh sake, if you own a fund that you wish you hadn't bought, don't let the dividends reinvest because you're just buying more. And here was an easy example. This was a Sequoia fund that was very hot for a very, very long period of time until they were incredibly heavily weighted in Valiant Pharmaceuticals and crashed and burned. And it was in a death, not only did it have high fees, but it's in what's called a death spiral. When a fund is underperforming, people yank their money, which causes them to sell more stock to raise the money, which causes the spiral to continue. Now, a financial advisor,
Alan?
you will, yes.
Excuse me. I think this is a key point. At least it's a hobby horse of mine about fund expenses. What they, you know, sort of the range of fund expenses and what you're getting when you pay more.
Yeah,
Does that make
you know,
sense?
yeah, the correlation, and I've got a graph in my book. The higher the fees, the lower the returns. And it's simple arithmetic. If the market earns 21% like it did last year, the average dollar invested in the market has to earn 21%. And the average investor will get that 21% minus the fees that they paid. So the more expensive the fund, the lower your return is going to be. Not every year, but an incredibly strong correlation. Did that answer your question?
Yeah.
Okay. Now, financial advisor, you want to pick me as your financial advisor because I'm a fiduciary. As a fiduciary, I'm obligated to put your interests ahead of mine. As a CFP like Evan, you know, we are part of the CFP board, which enforces a higher standard with planners being thoroughly vetted, and look for advisors who have been publicly recognized. If you walked into my office, you would see this beautiful plaque of one of America's top financial planners. So that's the spiel, the crooked spiel. Anyone that calls themselves honest, I'll never believe them. Okay. So the reality is that the fiduciary standard, it is not enforced. I've given data to Kevin Keller, who's the CEO of the CFP board, for many, many years about how any action they take comes way after that of other regulators. So the higher standard and the thoroughly vetted is just baloney. And Jason Zweig at the Wall Street Journal, he publicly exposed the hypocrisy of the CFP board. And I'm working on an article right now, the CFP board's reaction to being outed was really strictly to protect the CFP board's management, to do nothing for the consumer. And awards are really for sale to anyone. And I do mean anyone. So like I said, if you walked into my office, you'd see this beautiful plaque from the Consumers Research Council of America, one of America's top financial planners awarded to my dog, Max Tailwagger, who was also approved for one of Medical Economics magazine's best financial advisors for doctors. So we do all sorts of things to try to build credibility.
Alan, I'm sorry.
Evan, I insulted our CFP board.
Oh, that's okay. They can take it.
I've got to run. Sorry, nice talking to you guys.
No, real quickly, somebody would like more of an explanation of why reinvesting dividends is a bad idea. She said, I thought compounding interest dividends is a good thing. So when would it be a good thing and when would it be a bad thing to reinvest your dividends?
Well, it's generally a good thing if A, you are investing in a fund that is low cost, diversified, et cetera, and you don't need the cash to live on. It's a bad thing if you're in a fund that you wish you weren't in, that's more expensive, narrow, underperforming, because when you reinvest the dividends, you're just buying more of that same dog fund. Did that make sense, Evan?
Yeah.
Okay.
Yeah, thanks.
Anyways, that's what my dog, Max Tailwagger, who sadly passed away 6 weeks ago, would tell you. Okay. Now, taking Social Security, I've written about this ad nauseum. And by the way, any Social Security analysis you want to do, I strongly recommend opensocialsecurity.com. It's free, it's brilliant. It was created by a good friend of mine, Mike Piper, and it's the only calculator that I use. But anyways, I've been paying Social Security for so long that my instinct once I turned 62 a year ago, I wanted to take Social Security. Because I've been paying for it for so long, I wanted to get something out of it. Now, I would argue that mentally, I'm receiving roughly $2,400 a month. What I'm doing with it is buying an inflation-adjusted deferred annuity backed by the US government at a 40% discount when insurance companies used to offer such a thing. But insurance companies today, they're deathly afraid of inflation and they can't hedge against it. So that's why they don't offer these products any longer. So when I do a plan for a client, in the vast majority of the time, the high income earner of a couple, we're delaying Social Security until age 70, but I give them permission to go ahead and spend it because really what they're doing is buying that inflation adjusted deferred annuity. Tax strategies when you retire, I can't go through all of these, but oftentimes before you take Social Security, before you start doing the RMD, you can sell stocks with a 0% federal long-term capital gain. And sometimes it's, even if you're in balance, you go ahead and sell it, you buy it back again 1 minute later, and you've reset the basis of that if you're at the 0% marginal federal rate. And there is no 30-day wash gain rule. It's only a wash loss rule. So you don't have to wait the 31 days. Partial Roth conversions, tax deferred withdrawals, managing the marginal tax rates. I have a terrible track record of predicting politicians, but I got to believe, the odds are good to use up your 12% federal marginal tax bracket. Let's see, Roth conversions. This is a little bit more complex. I might skip this in the interest of time. A Roth conversion is when you just take money from a traditional IRA or 401k and you pay the taxes now, you convert it to a Roth under the promise with the government that it can grow forever and ever and be tax-free. And I'm a believer in tax diversification, having some taxable assets, tax-deferred assets, and tax-free assets, because we never know what Congress is going to do with tax rates. Financial wealth, typically it's measured in net worth. So someone with 10 million has 10 times the wealth of somebody with 1 million. And there's no quick way to get rich. And I say baloney. We should measure our financial wealth in how much we're worth divided by how much a year we need to be happy. So let's just say I'm worth $10 million. And Jeff, you're only worth $1 million. So I'm 10 times richer than you are. But let's say I need $5 million a year to be happy, and you only need $50,000 a year to be happy. Then I would argue I have 2 years worth of financial freedom and you have 20 years. And by the way, you're likely a lot happier than me too, because spending money doesn't buy happiness. And you can get rich quickly by spending, only on what brings you happiness. So take an inventory of what you're spending and whether it makes you happy or not. Next, I'm very proud of what I drive. I drive a millionaire's car. It's not a Tesla. It's not a Mercedes. My prior car was a Grand Prix that I bought mostly with credit card bonus points. My current car is a Chevy Volt that does 0 to 60 eventually. But when you look at what saves you money, there are things like the Starbucks factors that, yeah, it makes a difference, but it pales in comparison to a car. Buying a car that's just reliable, gets you from A to B just as quickly as the Maserati or the Tesla, in my opinion, is the way to go. So money and happiness, if you have enough to support the rest of your life, then getting richer is going to make you marginally happier. If Jeff Bezos makes another $1 billion, I'm sure he'll smile, but it's not going to change his life. But it's not a straight line. If you've won the game and markets plunge, and then you have to start making choices of, we're not going to do these vacations, I can't buy this extra house, I can't send my grandchild to college, etc. That's going to bring a lot of misery. So as mentioned, I wrote a book I'm very proud of about a dozen years ago. It's better today than when I wrote it a dozen years ago because it worked going forward. People typically write a book about what worked in the past. And these were the second grader portfolios. It's strictly a total US, a total international, and a total bond. So with the total US and total international, you owned 10,000 companies across the globe. Total bond, you own all investment grade US taxable fixed rate bonds. And the conservative was 30% stocks, moderate 60, aggressive 90%, only appropriate for an 8-year-old 90%. And they all performed roughly the same because stocks and bonds performed roughly the same. Now, I am not a buy and hold investor. I'm an active investor because I consider rebalancing active investing. And if you look at what happened so far this century, the buy and hold versus the buy, hold, and rebalance. And I'm not cheating. I'm not picking, March 23rd of last year to rebalance. That was the day the market bottomed because I didn't know that day the market had bottomed. But we really are, as my friend Dan Ariely's book says, predictably irrational. We get greedy and buy high, we panic and sell low. And if you can do the opposite, it builds wealth in the long run. Human nature is not likely to change. So anyways, that's my presentation. Or how are we doing on time?
We're doing good.
I can go through a couple of other items in the appendices, or we can go to the Q&A. Totally up to you.
We're pretty much caught up on Q&A, but I was going to ask you one question, and then we can go back to a few more points. We seem to have a lot of new attendees, which is really good from our standpoint. Are there 2 or 3 books or websites that you would recommend for somebody who's just sticking her toes in the investing world and is prime prey for all of us more than honest financial advisors out there?
Yeah, Jack Bogle's, he was the founder of Vanguard, the late founder of Vanguard. His little book of common sense investing, I think, is really good. I think I'm incredibly biased because I am a board member and the treasurer of the John C. Bogle Center for Financial Literacy. So if you go to bogleheads.org, it's just a good way of asking questions and getting advice from people that typically don't have a bone in the game. You get different pieces of advice, but I think that's a good place to go. Anyone who wants to learn about taxes, things like that, I strongly recommend Mike Piper's. He's got a whole series of 100-page books that are, make things as simple as possible. His book, Taxes Made Simple, there's nothing simple about taxes, but it's as simple as I've ever seen it presented. So those would be some good places to go. And then whenever you're buying something, I always recommend reverse engineering it. So in other words, what's in it for the person selling it to me? And then common sense. Whenever my phone rings and I make the mistake of answering it, and they've got this wonderful investment, never hit a dry well in the last 30 years. The investors are getting 30, 40% returns. Why the heck would they be calling me? They would have their current investors be pouring money in. They would not be, paying somebody 10% to try to sell this stuff. So common sense really isn't all that common, in my opinion. Be your own fiduciary. Don't invest in anything you don't understand, and take that one step further. Don't invest in anything you can't explain to any 8-year-old.
Alan, can I ask you a question?
Of course.
Yeah. So, I know you like index funds and, cap-weighted index funds. And I can understand that they're much better than an actively managed fund because the fees are less, and most actively managed funds are going to underperform the market anyways. So why not just use an index fund, because you'll outperform 90% of active managed funds. So I can understand that. My concern is more with risk. I think about risk more than I do return. And when you talk about like a S&P cap-weighted index fund, like right now, the technology sector, it's probably like overall, it's probably like 30% of a index fund, which scares me because, technology is kind of volatile. So like my own portfolio, I try to cap each sector at like no more than 15%. So, so when the market's going up, I'll underperform, but when the market's going down, I'll do better. So isn't that a better way? So what do you think about index funds, where the weighting gets ballooned, where it's like 30% of one sector?
I have those same instincts, Jeff, and I try as hard as I can to ignore those instincts. So the strategy that you've said, I've been hearing for many, many years, that certain sectors are overweighted, the large cap growth tech, et cetera. It's just becoming too much of the of a total stock index fund. And that's exactly what these smart beta type of strategies do. They still own the tech companies, but they own it in a much, much smaller proportion.
Yeah. Okay.
And it didn't work.
What do
And
you,
whenever you are overweighting parts of the market, you are increasing risk. You're not decreasing risk. And I have all of these instincts. I think tech is way overweighted.
yeah.
I'm a pessimist by nature. I always think the market is going to plunge. If I invested the way I felt, I would have everything in cash and had everything in cash my entire life.
Right.
So I try to ignore these instincts. And I think investing in 8 words is minimizing expenses and emotions, maximizing diversification and discipline. And whenever you're underweighting parts of a market, you're overweighting another part of the market, and that's active investing.
All right. But what do you think of Rob Arnett? He wrote that book, Fundamental Indexing. So instead of cap weighted, he weights it based on like dividends or whatever, on some kind of fundamental index. So what do you think of that strategy?
That's what this chart is. This chart, Rafi, is Rob Arnett's company. And you can see how it's under returned. And I think I mentioned I couldn't be at a conference, 6, 7, 8 years ago without hearing the term smart beta. And it's a viable active strategy, but it's not a strategy that I believe in. And some people experimented with drugs when they were young. I experimented with dimensional fund advisors, which is a really good fund family, an outstanding fund family. It's not Vanguard good, but it's really good. And it weights the small cap and the value. Those were the original 3 factors: the beta, the market, small cap, and value. Right. And what I found is that the expenses weren't worth it. Because it had to make trades. It was less that they advertised tax efficiency, and it's far more tax efficient than that Sequoia fund, certainly. Yeah. But it wasn't as tax efficient as a boring old cap weighted fund. I still have a couple of funds left there, mainly for tax consequences. But today at one point I was 5% DFA, 95% Vanguard. Now I'm about 1% DFA. 99% Vanguard / cap weighted indexing. So it's certainly not the worst strategy in the world, but it's not a strategy that I buy. Again, if I had a TV show, I wouldn't watch it. It would be too boring. Own the entire market. Don't try to outsmart the market. Buy a boring cap weighted index fund and rebalance.
Yeah. Okay. Jeff.
But I don't have strong feelings, do I?
Okay. Let me make a quick comment, and then there are 3 questions on a particular topic. When I first started as a financial advisor, I submitted a brochure, and one of the lines was, knife throwing should be exciting, investing should be boring, and compliance crossed that out. If you're looking for excitement, anyway, we have 3 questions, one of which all on Roth conversions. One asks if you would go back to that slide and I guess do a deeper dive on when it makes sense to do a Roth conversion.
Okay, let's see if I can find the slide. Here we go. Okay. Do most people understand what a Roth is versus a traditional? Do you think?
I think you should. We have a lot of new attendees. Why don't you start there and go?
Okay. A traditional IRA or 401k, you get a tax deduction when you make the contribution. And then it grows tax deferred until you later tap the money, and then it's taxed at ordinary income. A Roth is just the opposite. You do not get a tax deduction when you make the contribution, but under current law, it could then grow and grow forever, and you never pay the taxes when you pull the money out. And by the way, it works that if your tax bracket, the same year you make the contribution is the same as when you pull it out 30 years later. It doesn't matter, by the way, whether it's 1 year later or 40 years later, the math works out to be the exact same. Now, one thing that you're allowed to do is to convert some of your traditional, let's just say I had a $100,000 in my IRA and I wanted to convert $10,000 to a Roth, then I pull the $10,000 out and I say it's now a Roth and I pay the taxes on it. So if I'm in the 35% tax bracket, state and federal, then I'd pay $3,500 in taxes. But then it could grow forever and ever and I never pay any taxes on it. If I later pull it out and I'm at the 35% tax bracket, I'm at a break even. So if we think that taxes are going to be higher later, that's an argument to do a Roth conversion. But trying to predict what politicians do is, I've given up. In fact, if anything, I think I have a track record of always being wrong. I use logic.
A Roth would be, in a sense, a tax hedge.
Correct. Well, I argue that you want to have 3 different buckets of money: taxable, tax deferred, and tax free, as a hedge, because we never know what Congress is going to do. Okay. So should I convert that $10,000 to a Roth? I would argue there are several things to consider. If my Roth pot of money was small compared to the taxable and tax deferred, then I'm getting more diversification from doing that. So that's an argument to do it. Okay. Is my marginal tax bracket low? For instance, if I retired next year and I had very low income, then that would be an argument to go ahead and do some Roth conversion, especially if I'm delaying Social Security and my RMDs haven't started. Or let's say I'm starting a new business. And when I started my financial planning business, it was not an instant success. I had very low income, which gave me the opportunity to do some Roth conversions. Okay. Will you have high income in retirement? If you're going to have a high pension later on, then you're always going to be at a higher tax bracket. Will the RMCs be burdensome? Don't forget, the more money you convert to a Roth, the less money that you'll have to do in required minimum distributions when you turn 72. Number 5 is really important, especially if you're before 59 and a half years old. Do you have the money in after-tax account to pay the taxes when you convert from a tax deferred to a Roth? And then finally, well, I shouldn't say finally, but if you convert all of your traditional IRAs to a Roth, that allows you to do something called a backdoor Roth, which is a little more complex, but that's when you put after-tax money into a tax deferred IRA, and then the next day you convert it to a Roth because you'll have no additional income taxes due. Number 6, some states like Colorado, I think it's more than half. I don't know whether California is one or not, but they give you a state income tax exemption for money that you take out of a, California does not?
Not that I know of.
Okay. Most states, more than half do anyways. But yeah, California, and boy, I loved living in California. I miss it. I live mainly in the Bay Area, but a little bit in Ventura County as well. But no tax deduction for 529s or things like that.
Right.
You know, will you benefit from a state income tax exemption? That could be a factor. And this is really only for the ultra wealthy with taxable estates, which right now is 11.7 apiece, 11.7 million. So a couple has twice that. But there are some estate planning conversions, because the last thing you want to do is pass through an IRA to the children, because you're going to be paying 40%, or the estate will be paying a 40% estate tax on it, and the kids will have to be pulling it out over the next 10 years and paying ordinary income taxes on it. So there's an argument to do some Roth conversions so you're not double taxed on that, because the taxes that are being paid out of the estate passes on far more valuable money to the Roth. The kids will still have to pull the Roth money out in the next 10 years, but there are no taxable, it's tax-free money to them under current law. So those are things to consider. I've always said investing is simple. I've never said taxes were.
Okay, how about some simple guidelines on rebalancing?
Just do it. No matter how I can only tell you after the fact what the right time to rebalance was. And I can, what I typically do is set a guideline. For instance, if you were going to be 50% stocks, then we would write up the investment policy statement that says you have to be within 6 percentage points of that. So if it gets to 56%, you've got to sell. You could sell earlier if you wanted. You can rebalance every day for all I care. I think it's a waste of time. Or if you're below 44%, you have to buy. And that keeps your risk profile roughly the same. And it worked brilliantly last year when you had to buy stocks in March when stocks fell 35% in 33 days, but it doesn't always work that way. So I tell clients, I give them a range that they have to stick with, and I tell them, think of it as a binding contract. If they're outside of that range, they're in breach of contract, and I can guilt them to death, which will be worse than a large LA firm trying to ruin their lives.
Okay, I have a question for you, Alan. On comparing bonds to like immediate annuities. So, given the super low interest rates on bonds, wouldn't you be better off buying like an immediate annuity from New York Life, getting say 4 or 5% on it instead of having bonds?
Do you mean a single premium immediate annuity?
Single premium immediate annuity.
Okay. No.
Okay,
because if you think about it, if let's say somebody 70 years old buys a SPIA that pays them 6%.
Yeah.
Okay. They've got to live, let me do the math, 17 years just to get their principal back. So the comparison to bonds, you follow what I'm saying?
Yeah.
So that's another another misuse that my industry does, quite frankly, to trick people. So you look at New York Life, look at their balance sheet, look at what they are in. They're in bonds. They can't pay you 6%. And again, you've got to live 17 years just to get your principal back. So what you're doing is you're buying a bond fund with a duration for the rest of your life at a time when interest rates are near an all-time low. Now, of all the annuities sold by insurance companies, I think a SPIA is the least bad.
Right.
But think about it. If we do hit hyperinflation, if all this inflation that we're having is not transitory, just think about how that payment year after year after year is going to buy less and less and less.
Yeah, if you have hyperinflation, you're obviously screwed on the annuity, but you'd be screwed on the bonds as well if you just
not unless you bought an ultra long-term bond. That's why I'm a believer in more of an intermediate term bond Or another strategy that I often use are CDs that have easy early withdrawal penalties, so that if rates do go up, you pay that penalty, get out, and then reinvest it at a much higher rate.
Okay.
But
Do you
you
have
don't
any-
want to compare. The point that I really wanted to get across
Yeah.
is you don't want to compare, a 1.3% bond to a 6% SPIA, single
Uh-huh.
premium immediate annuity from New York Life or anyone. Those are
Yeah.
apples to oranges. Most of it is return of principal, just like that muni bond example.
Oh, right. And if you don't live the required number of years, you kind of gave up a lot.
Correct. And then you can buy certain things that have a 10-year period certain, et cetera, but insuring yourself for a long life and a short life simultaneously makes no sense, in my opinion. You're just paying fees on both ends.
Yeah. What, do you have any comments on, should people buy long-term care insurance?
Holy crud. It was the most difficult article that I ever wrote roughly a year and a half ago, because the data is all over the map. So if I want to prove any point, I can find data to support it.
Yeah.
You cannot buy a policy anymore, a pure long-term care policy, where the insurance company no longer has the right to raise fees. And
right.
premiums have gone up 50, 100%. I'll have so many people call me. I don't know what to do. I've been paying for it for 10 years. I'm closer to needing it now, but they just doubled my rates. What do we do?
Right.
And then there are hybrid policies that are, mixes between permanent insurance and long-term care. And those come with a lot of extra fees and the like. So it's a very difficult subject. I think if you don't have a whole lot of money, you should not buy it, because you're likely, if you need it, going to end up at a Medicaid sort of situation. And if you have a lot of money, and my clients are typically wealthy, I tell them to self-insure.
Right.
But it is pure insurance. It's just pure insurance that you don't know what you're going to be paying years later.
Right.
Yeah, it's a very tough one. We'll give you something easier. Would you like to comment on equal weighted funds?
Yeah,
I
avoid
guess
them.
an equal weighted index versus the traditional S&P 500 fund.
Yeah, first of all, I'm more of a believer in a total stock index fund than an S&P 500. And by the way, if you think about it, which did better, a small cap index fund, a mid cap index fund, or a large cap S&P 500 index fund, or the total stock market? You would think that the total stock market couldn't have been the winner, but it was. And that's because one company, Tesla, wasn't in any of the prior three. It was admitted to the S&P 500 on December 21st. But I'm a believer in owning everything, and I'm a believer in not outsmarting the market. So the equal weighted is going to be more small cap value, which is more expensive, less tax efficient, and has typically underperformed. So I'm a believer in a really boring total stock cap weighted index fund. Get your excitement somewhere else outside of investing.
So what would you advise? I've had a number of clients who have never had any investable income, working class, and the parents pass away and their house has gone up 700% in the years they owned it. And now this person has come into a couple of $100,000 and it's big bucks to them, but they have no investment experience or much financial savvy. What would you advise somebody like that? Not somebody who's got $10 million, but somebody who's inheriting $200,000 or $300,000 and it's got to last for 20 or 30 years.
Read the book, How a Second Grader Beat Wall Street. It's that simple. It really is. And I argue, clients I typically do not take on think of themselves as sophisticated. because I make the decision that it's not cost effective at my hourly rate to educate them on what they think they know. It's a person that, understands the arithmetic of investing, that it's much simpler to explain the concepts, is easier to help than somebody that believes that they can beat the market. And a lot of times people think that they're not trying to beat the market with these smart beta, equal weighted strategies, but they are.
But aren't they trying to lower their risk rather
No.
than?
Yeah, are they trying? Yes. Are they doing it because they think they're lowering risk? Yes. But they're doing just the opposite. They're increasing risk. When you pick parts of the market to overweight, you are increasing risk. Again, if we look at over a 31-year period where the average stock gained 7%, the median, whereas the market as a whole gained 2,100%, by not being smarter than the market is the key to getting the market return. Every time that you try to outsmart the market, whether it's equal weighted, smart, beta, not putting
Low
more
volatility. What do you
I'm
think
sorry?
of low volatility?
Yeah, the low volatility worked brilliantly in the past and failed miserably going forward.
Okay.
I too can predict, like I said, I'm willing on a recorded line to say I'm brilliant at predicting the past and horrible at predicting the future. And I make a living off of telling people that I don't know the future. It's a wonderful country we live in. If I had a TV show on investing, I wouldn't watch it. It would be that bad. Episode 1, buy the entire market, balance portfolio, rebalance, keep expenses low. Episode 2, see episode 1. I pitched this to CNBC. They turned it down for some reason. Go figure. I did not pitch it. Sure.
Let me ask you this other question. It's a tax question. So we don't know what's going to happen in the future, but suppose Congress eliminates the step up in basis and they double the capital gains rate. So for estate planning, I mean, that, like, how do you protect your estate if something like that happened? Do you have to buy like a ton of life insurance? Is that it?
No, the life insurance isn't going to do it. But number one, I'm a big believer in first you pick the asset allocation, then you pick the asset location. And for instance, if you looked at my taxable accounts, you'd see I'm very, very heavily in stocks. If you looked at just my tax deferred accounts, you'd say, wow, Roth is a weenie. He doesn't believe in stocks. He's all in fixed income. But if Congress did two things, all that planning would be for naught. And those two things are eliminating the long-term capital gains tax rate, for everybody, not just for the $1 million plus income, and eliminating the step-up basis. That would make all of that moot. But I've seen more people make horribly expensive mistakes off of doing certain planning, trusts, et cetera, believing that Congress was going to do something than getting it right. Far more people making the mistakes.
Yeah, but if they actually do it, then what do you do?
Yeah, if they actually did it, then that would negate all of the asset location work that I've done over the last 20 years. Right, now, so then, I gotta believe, I just said I'm terrible at predicting Congress, and here I'm gonna predict Congress again, so I'm a hypocrite.
Yeah.
But I think it would be almost impossible to administer eliminating the step-up basis. I have some investments that I bought decades ago that I have no clue what the cost basis is.
Right, right.
So I think it would be just a nightmare. I think that Congress often does what's best for them. And Congress is typically wealthy and they want their kids to have the money with step-up basis. Could I be wrong? Absolutely.
Okay, all right. Makes me feel a little better.
But I do not, notice on the Roth conversion slide, I do not predict what Congress will do with taxes at the very bottom.
Oh, yeah, I see it.
I mean, I look at where we are. Should I close, by the way, this screen share?
Yeah, I
You
guess
can,
so.
because we're going to have to wrap it up in 3 or 4 minutes.
Okay,
Oh, can I ask like one more question?
of course.
Yeah, here's the question. I have an inherited IRA, so I have to take an RMD every year. I'm only 66. So I was thinking what I read, when I'm 70 and a half, instead of taking the RMD, I could donate it to my Vanguard charitable, the donor advised fund, and sidestep, and not take the income, but you don't get the charitable deduction. Is that a better deal?
Yeah, that's a great way to do the, if you're going to make, if you have the charitable intent in the first place,
Right.
then yes, your two choices would be either, and I'm a big believer in lumpy contributions to a donor advised fund. I wrote about that in the Wall Street Journal.
Right.
But your two choices are either IRA RMDs or most appreciated securities that you own.
Uh-huh.
And the analysis is a little bit more complex on that. Your life expectancy, a whole bunch of different factors come into play. Like I said, taxes aren't simple.
Right. So, but that's a good strategy, is just to donate it and bypass taking the income.
Yeah, if you had the charitable intent in the first place.
Yeah, right. Yeah, I do. Yeah. Okay.
Okay, let me give you the last question, a two-parter. One, if you were advising, someone about how to choose a financial advisor, what would you say? And then if you have any last bits of wisdom before we take a break.
Asking a financial advisor how to pick a financial advisor. This is a little conflict of interest. With all my bias, I am a strong believer in the fee-for-service model, that every profession on earth, doctors, lawyers, accountants, fee-for-service. So I'm very much a believer in the hourly model that Jeff also has. We're very rare. I'm not taking on new clients, so I'm not trying to sell anything. I would ask the advisor, are they beating the market? What's their strategy? What's the worst investing mistake? If they can't come up with anything, they're not being forthright. But just, are they a believer in, what's their philosophy on costs, et cetera, rebalancing? They ask questions about taxes and, specific situations. I think that's pretty important.
Okay.
The second part of the question was final
Any
words.
final comments?
Okay. Minimize expenses and emotions, maximize diversification and discipline. Get the market return. Don't try to outsmart the market. Don't think that picking parts of the market reduces risk. It increases risk. Get your excitement someplace other than investing. Although it's fine to have a little fun gambling portfolio. I buy 1 or 2 stocks a year just to have a little bit of fun with. So have a wonderful life. Have an exciting life. Have a really, really boring financial strategy.
Okay. Thank you very much.
Okay, thank you,
We'll
Alan.
be back at about 20 minutes to 11. It's almost 10:30 now. Alan, thank you very much. It's
Thank
been
you.
very both informative and entertaining. Thank you.
You guys asked some tough questions, so thanks a lot. I enjoyed
Okay,
it.
thank you.
All right, thanks.